Hey everybody, welcome to this week's edition of Container Bytes from Freightos. I am Jude Levine, head of research. It's going to be just me this week as Julia is out on vacation. So let's jump right in. If we start once again with what's going on in the Strait of Hormuz, last week it seemed like we were getting pretty close to some sort of agreement. Iran and Oman had made announcements that they were getting close to an arrangement that would have Iran control entry into the Strait, into the Persian Gulf, and Oman control exits. It seems like this was kind of imminent, but since then it's basically fallen apart. Maybe not from the Oman-Iran side, but because of additional demands that Iran was making of the U.S., because basically this would be contingent on the U.S. removing their blockade. Iran has reportedly released a list of demands of the U.S. to have the Strait open, which included a ban on U.S. and Israel-linked vessels, transit fees for vessels from certain countries, as well as reparations from the U.S. for damage caused during U.S. strikes during the course of this war. And all that seems to have really pushed hopes back down that the Strait is going to open soon. And we're really kind of back to the wartime status quo, which is very few transits, U.S. a blockade, periodic attacks on vessels. And that's kind of back where we are, though there are statements kind of every day indicating that a deal is imminent, but so far those haven't materialized. One interesting development alongside this is that we've seen additional steps from carriers to increase transits through the Red Sea. Now, we know that the Houthis have been threatening transits through the southern part of the Red Sea, the Bab el-Mandeb Strait, since the beginning of the war, but hadn't really attacked any vessels since then. But just in the last few weeks, there has been an escalation, and this is really because of an escalation related to the Iran war, but more directly between Saudi Arabia and the Houthis, which is a conflict that has extended for several years now. The Houthis have attacked vessels linked to Saudi Arabia and said that they will attack vessels that are making port calls in Saudi Arabia. Even so, even though there's kind of an escalation there, where you've seen these additional steps, as we've said before, CMA CGM has been transiting through when most other carriers had stayed away from the Red Sea, and they're continuing to kind of restore or increase some of the sailings through the Red Sea. Now we have Hapag-Lloyd and the Maersk reinstating some of those sailings, and also Cosco. So we have, several steps by several carriers back towards the Red Sea, and this may be a beginning of a more general return. Although again, we've seen these stop and starts before related to what's going on with the conflict in Iran. So this is another kind of source of uncertainty, but maybe an encouraging step to see carriers willing to start going back, even though there's this conflict continues. What has all this meant for container rates? The answer is really not much. The Strait of Hormuz closure, the big impact is on the price of oil and therefore the price of fuel. And that's probably setting or impacting the floor for where container rates will go. But for now, as we've said, really since late May or at least the beginning of June, container rates have been driven by peak season trends, and that's where we still are. So as we've said, there was an early start to peak season this year for various reasons related to Strait of Hormuz and price increases that were coming there. And because peak season started early and rates increased very, very early already by early June, there was the anticipation that rates might start cooling early as well. The peak season might start easing earlier than usual as well, and that seems to be the case for Asia-Europe. Carriers now are increasing blank sailings for August. They're canceling or reducing planned mid-month rate increases in August as well, and spot rates are falling too. So prices have eased about $1,000 and about 15% for both Asia to North Europe and the Mediterranean since reaching that peak in early June. Last week's averages decreased 8% week on week. And now there are about $5,000 to North Europe and $6,000 to Mediterranean. Daily rates so far this week are also easing slightly, but at about that level. So these price levels are back to mid-June levels, but they're still about $2,000 per FEU, higher than they were before peak season demand started in mid-May. So the fact that rates aren't kind of cooling more significantly might point to a couple things. One might be that demand is still elevated, but not at kind of the peak levels it was earlier in the summer. But also that congestion is really a factor now. So there's both congestion in some of the hubs in Europe that are dependent on the Rhine River for inland transportation, and that might be causing a backlog of containers at these ports because water levels for the Rhine are extremely low right now due to drought, and that's causing some backlogs there. And the other, and this is true across lanes depending on the Far East, has been just a series of typhoons, 3 really significant typhoons over the last month or so that have continued to batter some of the major hubs, including Shanghai in the Far East, and is causing serious congestion there, which absorbs capacity and puts upward pressure on rates. So that might be why rates are still quite elevated, even if they're coming down from those highs. On the Transpacific, same thing in terms of early start to peak season, and there was an anticipation that we'd start to see an early cooling as well. But even though rates on Asia, Europe, and Transpacific had kind of moved in tandem since late May, in recent weeks, those rates have diverged. So starting with the East Coast rates hit a high of $9,000 per FEU in June, when basically all these lanes had hit their peak season peaks, but rates have kind of stayed there since then. And just this week, they've started to trend up to about $9,400 per FEU. West Coast prices reached a peak in July, have fallen about $1,500 since then. It was a high of $7,600, had fallen back to about $6,000 per FEU. And that seemed to indicate that demand was easing, early start to peak season, early end. But rates have now climbed about $1,300 since the start of August, back to $7,400. So just $200 short of that earlier peak. Now, it might be that actually that decrease in rates was a function of an increase in capacity as opposed to easing demand. So carriers, because rates were so high, had started injecting capacity, adding extra loaders to the lane to capture some of those elevated rates and service the demand there. And that might have caused that decrease in demand. Now we might be seeing capacity, being adjusted a little bit and prices are going back up. But either way, it seems that demand is still there. So even if demand peaked in July, it seems that demand is still significant on these lanes. And this has been surprising to a lot of observers, including me. I thought that the early start would mean an early end. National Retail Federation had kind of projected that early in the summer, that July was going to be the big peak and then a pretty sharp drop August and September. Now they've revised that to say that August and September are going to be still quite elevated and more of a sustained July, August, September peak, which is pretty normal even if we had that early start. Why is this the case? Why have possibly things changed? It's possible a couple reasons. One might be that tariff deadline. So some of that early start might have been to get ahead of July 24th tariff deadline. A lot of shippers might have anticipated that tariffs were going to increase after Section 122 tariffs expired. And more or less, they were replaced by Section 301 tariffs that were quite similar, both at about 10% for a lot of imports from a lot of countries, or 12.5%, which isn't a huge increase. So it's possible that because tariffs kind of didn't change that much, that some shippers who had anticipated stopping at this point are deciding, we'll continue our orders because we're not seeing those big increases from tariffs. The other part might be some caution on the part of some shippers that were ordering, but weren't kind of pulling forward earlier in the summer. But now that they kind of see that consumer spending is holding up, that there continues to be this resilience, then that consumers are continuing to spend, that might have increased their expectations for the big shopping events coming up, and that therefore they are increasing or continuing to order. And so those might be why we're seeing demand hold up for longer than a lot of people expected. In air cargo, not so much big changes here. We've seen rates increase a little bit in the last couple of weeks, possibly from increases or introductions of adjusted higher emergency fuel surcharges from some carriers because of rising jet fuel prices, which have kind of leveled off but have increased significantly since the collapse of the U.S.-Iran ceasefire since early July, and some of those surcharges are being introduced now, so that might represent some of those increases. China to North America, for example, increased about 6% last week, up to about $6 per kilo, and China Europe rates increased 2% to go above $4 per kilo. And that's what we have for this week. Thanks for listening, and hope to see you next time.